risk of an actual recession is rising. We saw the inversion in 3-month 10-year Treasury yield curve. It's back to positive now. It's got to, kind of get some real, area under the curve there. I do believe it will. It will eventually, but it hasn't yet. But again, let's just assume that it will. It inverted last week. What you want to find, or so one thing that's important to note, that when this thing inverts, it's obviously signaling recession. The thing is 100% hit rate, just like the last two indicators have 100% hit rate in terms of the inversions. You get an inversion there, you get an inversion here, you get an inversion here, and you're going to get a recession. We know we're headed for a #actual recession. Again, we just don't believe it's going to be imminent. And one of the reasons we don't believe it's going to be imminent, skipping this slide here, is the back test on the economy for the 3-month Treasury yield curve inversion. We talked about this in the Around the Horn last weekend. If you look at the percent positive ratio on real GDP 3 to 6 months forward from the inversion, 100% percent positive ratio. What that means is the economy is still growing in the 0 to 6 month interval from the date of the inversion of the 3-month 10-year yield curve inversion. Not the date of when it fills in the area under the curve, the date of that initial inversion, which again, for our date was going back to last week. 6 to 12 months forward, there's a 75% chance that the economy is not in an actual recession. And then you got to go 12 to 18 months forward for that math to reverse, and that math to flip in the direction and support of having an actual recession. So this is where, we don't just lick our thumb and say, I think the economy is going to be in recession in Q4 of next year or 1Q of 2024. This is where we're getting that information. You take 12 to 18 months forward from October of 2022, and you wind up in Q4 of next year or Q1 of the following year. So that's where we're getting this information from. Definitely, when you see these tables, we don't have time to go through all of them on this program, but definitely make time to go through and print them out, study them, because I think this is some really important analysis, very important cycle analysis, is what we call respecting the x-axis. Understand the sequence of events and how long from catalyst A to catalyst B. A lot of times when investors, invest, they realize that catalyst B is coming because of catalyst A, and then they put the trade on. If catalyst B is not for 3, 5, 10 years, like a lot of crypto folks believe catalyst B is, then you don't necessarily need to wear the risk associated with going from catalyst A to catalyst B the entire time. You want to manage risk on the market cycles and liquidity cycles in between catalyst A and catalyst B. And that's what we're trying to do when we say respect the x-axis, is understand how much time between the two catalysts. Because if you don't need to wear that risk the whole time, you shouldn't. Because again, the market will punish you for putting that risk on at the inopportune time as it relates to the growth cycle, the inflation cycle, and most importantly, the liquidity cycle.